Hey there! Most people hate taxes, especially when they're not being used the way they should be. You've probably seen those news stories about how the rich somehow avoid paying taxes, while regular people like you are left paying the bill. Isn't not paying taxes supposed to be illegal? So how did they get away with it? Well, the rich have so many tricks, some of which I've covered in my previous video, How the Rich Avoid Paying Taxes. Link in the description. And one of their favorite strategies is using tax havens. No, it's not a heaven or paradise where taxes go to die. So how does this tax haven actually work? In this video, we'll dive into what a tax haven is, how it works, some famous examples, and the solutions. So let's get started. Section 1. What is a tax haven? So the word tax haven comes from tax, which is, well, tax, and haven, which means a place of safety or refuge. Yeah, it's haven, not heaven. So a tax haven is a country or territory that people or businesses can pay very little to even no taxes at all. And not only that, a tax haven also provides strict privacy, which means they won't tell anyone who's putting their money there. Sounds like a dream come true, right? With little to no taxes, combined with high secrecy and privacy, it makes tax havens really a heaven and paradise for rich guys and companies that do not want to pay taxes. Actually, there isn't one clear definition of a tax haven, which is why some people might say country X is a tax haven, while others say it's not. But to be considered a tax haven, a country or territory typically has three main criteria. First is little to no taxes. Taxes like income taxes, corporate taxes, or other taxes are super low or don't exist. Second is strong privacy. Your identity will be kept secret and rarely disclosed. Third is stable country. The country is politically and economically stable, so people feel safe keeping their money there. So now you already know the definition of a tax haven. So how does a tax haven work? Well, we'll talk about it in the next section. Section 2. How does a tax haven work? Since not paying taxes is often seen as unethical or controversial, tax havens use clever and complicated strategies to allow people and companies legally to pay little or no taxes without making it look too obvious. And of course, it's not about just hiding the money under a mattress. If you watch my previous video about how the rich avoid paying taxes, I've explained two strategies of using a tax haven, which are CFC and transfer pricing. But in this video, I will explain it again briefly, plus with other tricks. The first trick is a CFC, or Controlled Foreign Corporation. A controlled foreign corporation is basically a company set up in a tax haven, often used to shift profits to these tax-friendly countries, avoiding higher taxes back home. For example, Apple, the company that makes the iPhone and other electronic stuff, avoided paying a huge amount of taxes, about $44 billion in just 3 years, from 2009 to 2012, by setting up shell companies. A shell company is a company that doesn't exist physically. No office, no employee, it just exists on paper. A shell company is commonly used to either hold money or take benefits from tax havens' weird tax laws. So one of the first shell companies was called Apple Corporation Euro in Ireland. So in Ireland, a company is taxed based on where it is managed, while in the United States, a company is taxed based on where it is registered. Apple took advantage of this difference. By registering a company in Ireland, the US did not tax the company because it was registered in Ireland. Additionally, by having management control in the United States instead of Ireland, Apple avoided Irish taxes as it's controlled in the US, not Ireland. So the result? Apple got no tax at all. The second trick is transfer pricing. This is when a company moves money from its home country to the tax haven by making internal transactions. This helps shift profits to places with lower tax rates. For example, imagine Wee Wee Shoes Company, a company in the US sells a new shoe model and get $2 million in revenue. After subtracting the production costs, the company got $1 million in profit. Normally, if they made $1 million in profit, they'd pay around 21% tax, which is $210,000. But instead of paying that, Wee Wee Shoes Company decides to use a tax haven like the Cayman Islands, which has 0% corporate taxes. So if you don't know, the government lets the company pay all their costs first and will just tax the net profit. So if the Wee Wee Shoes Company transferred the money directly from the US to the Cayman Islands, the IRS will assume that this money is net profit and will be taxed 21%. So it's basically useless as it's taxed. So the Wee Wee Shoes Company sets up a branch in a tax haven like the Cayman Islands. They transferred their intellectual property, like the brand, copyright, patents, and shoe designs, to their Cayman branch. Now, when they sell the shoes, they get $2 million in revenue and $1 million production costs. And then they claim to pay another $900,000 cost in royalties to their Cayman branch for using Wee Wee brand, design, and copyright, leaving just $100,000 in the US to be taxed. With the transfer pricing trick, Wee Wee Shoes ends up paying $21,000 in US taxes and keeps $900,000 untaxed from the Cayman Islands. So in the end, it got $979,000 in profit after tax. Well, that's great. But now there's a new problem. How can Wee Wee Shoe Company in the US access the $900,000 sitting in the Cayman Islands? If the Cayman Islands branch directly transfers the money to the US company, it would be taxed by the IRS, as international money transfers into the United States must be taxed. Well, there's another trick. The Cayman Islands branch can just give a loan to the Wee Wee Shoes Company in the US. If you watched my video about how the rich use debt to get richer, you'll know that loans are not taxed because the government assumes that the borrower is burdened by paying interest. Since it's an internal loan, Wee Wee Shoes Company can set the terms however they like. For example, they could set an interest rate of just 1% and the repayment period of 100 years. And most important is none of this is taxed. The third trick is the double Irish and the Dutch sandwich. Sounds delicious, right? Well, we're not talking about food, because this was one of the most famous CFC and transfer pricing strategies that was commonly used. So here's how it works. Using the same previous example, that the US Wee Wee Shoes Company got $1 million in profit, it means they need to pay 21% US corporate tax, which is $210,000. And of course, the company does not want to pay that much. So this time, the company uses the double Irish-Dutch sandwich strategy to avoid taxes. First, Wee Wee Shoes Company sets up a company in Bermuda, a tax haven with a 0% tax rate. Then the US company creates a shell company in Ireland called the First Irish Company that holds all the intellectual property, like Wee Wee's brand, copyright, designs, and patents. And the Bermuda company creates the Second Irish Company, which is controlled from Bermuda but located in Ireland. Finally, Wee Wee Shoes Company creates another shell company in the Netherlands because the Netherlands has tax treaties that allow tax-free money transfers. So this is the trick. Now, Wee Wee Shoes in the US pays $900,000 in royalties to the First Irish Company for using the intellectual property. This lowers US Wee Wee Shoes Company profit to $100,000, so they only pay $21,000 in US taxes instead of $210,000, which is the same like before. Then, the First Irish Company quickly transfers the $900,000 to the Netherlands Company to avoid Ireland's 12.5% tax. Thanks to tax treaties, this move is tax-free. The Netherlands Company then also quickly sends the money to the Second Irish Company to avoid Netherlands' 25% tax. And still remember the Irish tax law? As Ireland only taxes a company that is controlled in Ireland, So the second Irish company does not pay Irish taxes because it's controlled from Bermuda. Finally, the money moves to Bermuda. And the money is in Bermuda, where it has 0% tax rate. So the $900,000 went untaxed. And as usual, the Bermuda company just needs to give a loan to the US company. So the $900,000 returns back to the United States as internal debt untaxed. And what's so special about this double Irish and Dutch sandwich? Well, big corporations like Google and Apple admitted that they were using this trick to save billions of dollars in taxes. But the European Union forced Ireland to close the loophole in 2015, and the trick is no longer used after 2020. Well, those are some strategies. And now you might wonder, why would any country want to be a tax haven? Isn't no tax means no money? Well, we'll talk about it in the next section. Section 3. Why countries become tax havens. Surprisingly, many tax havens are small countries with limited natural resources that most foreign investors have no interest in them. For them, offering tax advantages is a way to attract foreign businesses and wealthy individuals. These countries earn money through registration fees, banking, trust, insurance, and other financial services. For example, if a big company makes $10 billion in profits and wants to avoid paying, let's say, 21% taxes, which is $2 billion, by moving profits to the Cayman Islands, they might pay only $5 million, which is 0.05% in fees instead. For the multinational company, this 0.05% of their revenue is super small. But for a small country like the Cayman Islands, with around 90,000 population and a GDP of $5 billion, then $5 million is a big deal, as it is 0.1% of their whole GDP from only one company. If there's 10 companies, it's already 1% from their whole GDP. What is small change for corporations can mean everything for small tax havens. Section 4. Examples of famous tax havens. Now that you know what tax havens are, let's look at some real-life examples. Countries like the Cayman Islands, Bermuda, the British Virgin Islands, and the Bahamas are famous for having little to no corporate or personal income taxes. On the other hand, places like Singapore, Luxembourg, Hong Kong, and Cyprus are known for their relatively low tax rates compared to many other countries. This is ideal for people or businesses who want to save on taxes without being too obvious. Some countries, such as Switzerland, Liechtenstein, Panama, and Monaco, are famous for financial privacy and secrecy, though there's been growing international pressure for greater transparency in recent years. And there's some tax havens that have regular tax rates but offer special tax breaks for specific industries. For example, the Netherlands gives low taxes for intellectual property. Malta gives low taxes for gambling companies. And Ireland offers low tax rates for tech and pharmaceutical companies. Although they recently agreed to raise the corporate tax rate to 15% as part of a global tax agreement. Well, those are some famous tax havens. Now, let's see the controversies of tax havens. Section 5. Controversies and Solutions. Tax havens might seem helpful for businesses, rich people, and small countries, but they can cause big problems for everyone else. One major issue is that tax havens take money away from governments. When big companies or wealthy people move their money to tax havens, they avoid paying taxes in their home countries. This leaves less money for important things like schools and hospitals. Governments then either cut services or raise taxes on regular people like the middle class, making the gap between the rich and poor even bigger. Tax havens also are hotspots of criminal activities. Their secrecy can let criminals do money laundering, avoid taxes, or hide illegal money. Scandals like the Panama Papers exposed how much money is hidden this way. So what can be done about it? One solution is for countries to agree on a global tax rule. In 2021, over 130 countries decided on a minimum corporate tax rate of 15%. This is supposed to stop companies from moving money between tax havens to avoid taxes. Another idea is to make companies pay taxes where they actually do business instead of where they register their profits. So the company would be taxed before sending anything. For example, the European Union forced Ireland to close the double Irish loophole. Now, Irish tax laws require companies doing business in Ireland to pay taxes there, regardless of where the company is headquartered or controlled. Of course, dealing with tax havens isn't easy, but with these solutions, we're moving in the right direction. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.